Our session today will be part one. We call this a capital asset pricing model. This is simply a model that explains the relationship that exists between risk and return. We know that risk and return have an inverse relationship. Okay? More risk is higher return. So we have different investors that we have. There's what we call a risk averse and a risk seeker. Can somebody explain to me these three types of investors? We have three categories: the risk averse, risk seeker, and risk neutral. What characteristics do we have about these investors?
I think someone who's risk averse doesn't like to take risks, and then risk neutral. This could be someone that could fall either side, can take risks, and doesn't like taking risks. And then what's the last one?
The risk neutral.
Risk neutral. I think that's someone who falls either side, where they can take risks or they don't mind taking risks and they don't mind not taking them. They just fall on either side. Averse is someone who doesn't like risks, who doesn't is not willing to take risks.
What are the others saying about that? On the types of investors that we have and the risk appetite attached to each of them. So the idea here is that investors are compensated for the risk that they take in investing in certain projects. So we must understand the assumptions under which the Capemmodel model operates. Is that number one, investors are rational and generally they are risk averse. The Capemmodel model also assumes that no taxes or transaction costs exist. The Capemmodel model also um, assumes that um, investors have the same expectations. So we are going to look at the Capemmodel model, which is used to measure risk. Now, risk measures the degree of volatility of particular assets. And we have a coefficient called beta, which is a measure of risk. So when beta is equal to 1, it means that compared to the market stock, it's moving in tandem. If it's above 1, meaning it's more volatile or risky. If it's below 1 or less than 1, it means it's less volatile. So these are the measures of beta. So beta is equal to 1 means it is moving in the same pattern or direction. And below that, it means moving above the market return, or it's riskier than the market. Then if it's below, it means it's less volatile. So we have what we call the SML curve, right? SML curve here, the security market line. So this gives an illustration of the relationship epitomizing the Capemmodel model. So Capemmodel model is given by the return is equal to risk-free rate plus the expected market return minus risk-free rate and beta. So the difference between the expected market return and the risk-free rate is known as what? The market premium. Okay, so we use this formula to calculate or to explain the Capemmodel model. So we're going to look at examples that will reflect on this formula. This formula doesn't mean usually it's coupled with Gordon. So this capital asset model, it gives us a very powerful way of understanding how risk really affects our expected return. And so the risk-free rate is usually our treasury bills. It represents the return that an investor can earn without actually taking any risk. We usually refer to treasury bills because treasury bills are one of the safest um, investments one can undertake because government is known to never default. Okay, it's a very slight moments when you expect your government to default. Okay, so we're going to use that formula to explain this model. And secondly, the expected return, ERM minus risk-free rate, is called the market premium. It actually represents the extra return that investors expect for investing in the overall market instead of a risk-free asset. In other words, what I'm saying is that this talks about the reward for taking on the average market risk. So expected market return is actually the expected return on the market portfolio, like the stock market index. And the risk-free rate, or RF, is what gives you the additional return that you as an investor may demand for bearing that risk. Beta, like I said, measures how sensitive a particular asset is to the movement of the overall market. It actually reflects the level of systematic risk which we talked about, okay, or market risk. So when beta is equal to zero, it's moving exactly with the market. Above or greater than one, it means it's volatile than the market. Below one means it's what, less volatile. Altogether, this is computed in what we call the Capemmodel model. The Capemmodel model is the formula we're going to look at now. So I'll give you two examples, then we look at the exam question that was shared. So now we have been given a beta stock of 1.2 and the risk premium is 6% and treasury bills offer 8% risk-free return. So you're asked to calculate the rate of return. So using this formula, return is equal to risk-free rate, the market risk minus risk-free rate times beta. So this has already been computed. Sometimes you may be given the market return, but this all collectively is what is called the risk premium. So where there's ERM minus RF, we're just going to put what? The 6%. So 8% is a treasury bill plus 6% times 1.2, we get 15.20. I don't want you to get lost at that point. All right? So when we adjust the return and maybe beta is increased to 2.0, what happens? We just multiply the 6 by 2.0, we have 20%. What about when beta reduces to 0.5, what happens? Our return is at 11%. So are you seeing what's happening? When we increase beta, our expected return is increasing. When we reduce the beta, our expected return is also doing what? It's also um, reducing. So this is how we compute the CAPM model. So now let's look at the example that I just sent on the group. Before I proceed there, any questions?
Not a question. I just feel like you're moving a bit too fast. I don't know what the others see.
Okay, maybe let me repeat myself in case I lost anyone. We are talking about the um, so we are looking at the CAPM model. What did I say is the CAPM model? The CAPM model is simply a theory in finance that we use to describe the relationship that exists between what we call systematic risk and our expected return. So it was developed by me, William Shep, and John. So the CAPM model was used to price risky securities and to determine the appropriate required return for the asset. So the core idea here is that an investor must be compensated in two ways. Number one, the investor must be compensated in time value of money using the risk-free rate. The other assumption is that the risk premium um, should be another way that an investor must be compensated. So the Capemmodel model is given by the following formula. Expected return is equal to risk-free rate. Um, the formula that is beaming here is the formula for our Capemmodel model. Risk-free rate plus market return minus risk-free rate times beta. Okay, so that is the formula for our Capemmodel model. Very simple looking and widely used. So the parameters can be explained as follows. So the expected return, ERM, is actually market return, the expected return of the asset that you want to compute. Then RF is a risk-free return that can include government treasury bill. Then B stands for beta asset, which measures our systematic risk. And ERM is the expected return on the market portfolio. It can be Osaka Stock Exchange share, S&P 500. So, and ERM minus the risk-free rate collectively is what gives us what we call the risk premium. Okay, basically that's the majority of what you need to know. Now, what is this beta we're talking about and what does it measure? This B. This B is very important because it measures our degree of risk. This B here. Okay, I'm taking my time so that you understand this question very well. So you can manually calculate B, or you can be given B by the examiner. So that B that you're seeing there has its own implications. So the B measures our sensitivity of stock compared to the overall market. It shows us how risky the stock is in relation to the market. So if the market goes up, meaning beta will tell you how much stock will move. Beta actually focuses on only the market risk, which we call systematic risk. And systematic risk by nature cannot be what? Diversified. Okay? We cannot diversify this kind of risk. Are we moving together so far? Have I lost anyone? So what happens when risk is above 1? What happens when risk is equal to 1? What happens with the beta is less than 1? So those things are what I need you to also explain in your simple understanding. So the formula has been given. Beta is the covariance between two assets. They talk about how the stocks move with each other, that's positively or negatively related. And the VAR is the variance, okay? It talks about how much the market fluctuates within itself. So if you have a high covariance, it means that the stock are moving closely to the market. So those parameters are very important. When your beta is equal to 0, what does it mean? You have no market risk. It simply means that stock doesn't move with the market. The best example of B0 is a treasury bill. When your B is between 0 and 1, it means you have low risk. What does it mean? You are less volatile than the market. What does it mean? It means there's less risk in there. Examples are utility companies. When beta is equal to 1, it has average risk. It moves exactly like the market, like the market index funds. If it's greater than 1, it means that you have high risk, so I mean it's more volatile than the market. Examples, we can look at what? Technological companies, okay? Small cap stocks. If it's less than 0 or negative risk, it means you move opposite to the market. For instance, gold, right? So that is the implication. So that is what is meant by the explanations of beta. So we can go down again to explain the other key parameters in the Capemmodel model. So there's what we call the SML line. What is the SML line? The security market line. What does it do? What is it? What is the SML line? So when you're talking about the SML line, it's simply a graph that shows the relationship between risk and expected return. So our x-axis usually has our beta, which represents systematic risk, and the y has the expected return. So this SML line shows the minimum return that investors will require for taking a given level of risk. Okay, and the equation is given as shown in this equation. So that is how the SML line looks like. So this SML line looks something like this. So the SML line has those components that you can see there. So it has the intercept, which is RF. This is the risk-free rate. It is the return when beta is zero, like the treasury bill. So this is our um, intercept. This is where it's cutting the y-axis here when our beta is zero. Then what else does it have? It has our slope, which is the risk premium. So it shows how much extra return investors demand for taking high risk. So if the slope is steeper, meaning there's high reward. Okay. All right. So that is what we are talking about. Then beta measures the level of risk. So all beta increases the expected return. So how does this SML curve works? So on every point on the SML line, it represents a fairly priced asset. So the line shows our required return. So this is what I've been trying to explain now. So all this jargon is just explained in this equation now. So when we're given our stock with beta 1.2 and risk premium 6%, how do we calculate the return on stock? Okay, so here we've been given the beta as 1.2. So where there's beta here, we go to 1.2, and we've been given the premium. So the premium is the difference between the risk-free rate and this one here. So that one is here. Then we've been given what else? The market return of 8% or market risk-free rate of 8%. So just put them in there. So where there's risk-free rate 8%, the return, you don't need to put a risk-free rate because all this is premium. Now, if in this case we're given the following, our risk-free rate was 8%, our beta was 1.2, and our ERM maybe was 14%. So how do we compensate in this formula? So where there is risk-free rate, we put what? 8%. So the return is equal to 8%. Then plus where there is a market risk, we put what? 14%. So we put 14 minus what? The risk-free rate again 8% times the beta of 1.2. So we're going to have 8% plus 14 minus 8, 6%, which is a premium. So collectively, when you calculate this, it becomes the premium times 1.2, just to give you 15.2%. Okay, so I usually have a problem with the students uh, misunderstanding those two. Okay,
Explain a bit on the premium. Is that whole thing the premium or just the RF?
the premium is the difference between the ERA minus RF. So the examiner sometimes will just trick you by giving you what? Giving you the risk premium on its own. Okay, so I don't know where you're missing it. So risk premium is the difference between ERF and what? RF. So they'll calculate it for you sometimes directly. So with that being said, you're analyzing a mature manufacturing company with the following data. The risk-free rate is 6%, the expected market return 13%, the beta is 1.2. Okay, dividend just paid now is 1.8, the expected growth is 5%, and the market price is. So let's calculate the return on equity using the Capemmodel model. So what's the formula of the Capemmodel model, Melissa? Return is equal to what? Andy?
That's
Uh-huh,
R plus, or
uh-huh,
basically risk-free,
uh-huh.
plus the premium, which is expected return on the market, less risk-free. Then you multiply that by beta.
So what is our risk-free?
Risk-free is 6%,
Uh-huh. Then expected market return?
plus our expected market return 13%,
Mm-hmm. Then minus what? The risk-free rate again?
minus the risk-free again. Then
Mm-hmm.
you multiply that by 1.2, which is the difference.
Yes. So what do we have now? 13 minus 6 is what? 7% times 1.2. So what do we have?
8.4 plus 14.4.
This is 14.4. 7 times 1.2.
No, that one is 7 times 1.2. That's 8.4.
8.4.
Then when you add 6, that's when you add the 14.4.
14.4%. Okay. That is using the Gordon's the Capemmodel model. Now let's calculate the value of stock using Gordon's model. What is the value of stock using Gordon's model? What's the value of stock using Gordon's model? I taught this, we're revising. D1,
Now you divide that over the KE, with market return minus the growth.
Over PO plus G.
okay, over PO, D1 over what?
PO plus G.
Are you sure? Gordon's model?
KE minus G.
Yes, D1 over. What is PO is what? Maybe I'm the one misleading you. Start. What is the intrinsic value
In
of
the
stock?
afternoon, we were told that if the dividend has already been paid, we
Uh-huh.
use the DO one plus is it one plus G? The
Like this?
DO one plus G is no one DO, then right there next to the DO one plus G.
Yeah, so
No,
D1
this is
is the
what
same
we need
as
to
DO 1 plus
DO.
G.
Okay, yeah.
Okay.
So D1
So PO therefore is equal to
over
what?
PO
DO 1 plus growth over what?
over PO.
K
K minus G.
over, yes,
So what is our D0? Do you have D0 here?
1.8,
1.8. Uh-huh. Then the growth.
5%.
So 1.05. Okay. Over. What is our K?
Is it 13%?
Our K is what?
13%?
13%. Uh-huh. The K is here. We calculated it. 14.4. So 0 point what? 144 minus our G.
why are we using the one that we've calculated using the other
Yes.
model? Aren't
Our
we not
model.
supposed to use the information in the question?
It's intrinsic value using the Gordon's model based on the previous answer. Yes. Okay. So what do we get when we calculate that? 20.11. That is the intrinsic value. So what was the market value for the stock? It was 28. And the intrinsic value we've just found is what? 20.11. So which one is better? What can we say? We can simply say that what? The market price is greater than the intrinsic value, so it is overvalued. Okay, so I'll send you questions on the Gordons. I don't know what revision you've been doing during the day.